Yo, I'm Brendan. Here are 40 financial terms that you'll use every day for your own financial literacy. Knowing these terms has helped me to make better decisions, to get better loans, to invest better, and to just generally navigate the world of business in a more efficient way. Word number one is contribution. And think about this in a positive way. Whenever you're contributing money to your family or contributing food to the dinner table, that's a nice positive thing. You're bringing something and you are adding value. And that's just what a contribution is. Like whenever we're in our investing accounts, whenever you're contributing money, you're sending money into it. So it's a weird term, but that's what it means. In contrast to that, returns are kind of the other part of your investing accounts. Like if you've got money invested in the stock market, everything in that account is probably either a contribution or it's a return. It's a profit that you've made. So don't think of it like a return, like you're returning stuff to the store. You're not getting something back necessarily, like money is coming out of the account. It's just the benefit of having been invested is your return. The money has grown by the amount that the return is. So that's very cool. Word number three is a 401k. 401k is a tax advantage retirement account that's hosted by your employer. So you just can't have one of these alone on your own without having a job that offers one to you. It's cool because you get tax advantages in the year that you contribute money to it, since we know that word now. And they can also be awesome because some employers offer a match. So let's say the first 3% you put into the account, your employer might match that dollar for dollar. So you're doubling your money. It's like 100% gain right off the bat. It's very, very powerful. Word number four is gross income. So don't think of it as nasty income. Gross means before tax. Think of it like if you get hired and somebody offers you $100,000 per year, that's not your after-tax income that you can spend on burritos and race cars. That's your before-tax income that you're forced to then pay taxes on and do everything else out of. That's just the starting place. Word number five is net income, and that is your take-home pay, your after-tax income. That's what you're actually able to spend day to day on burritos and race cars. Word number six is compound interest, and it's the eighth wonder of the world. Think of it as the money that you've contributed to your investing account grows. Then more money grows as a result of that new group. Then that new group grows faster because of all of that growth, and it just keeps going faster and faster and faster. And the incredible thing about compound interest is that it never really slows down. It only speeds up. When things are compounding, think about a parabolic curve, and that's what your investing account can look like if you invest for long enough. Number seven is one of my favorites, financial independence. We haven't reached it yet, but we're on the road there. And what this means typically is that the value of your investments are such that you can withdraw some money from it every month or every year, and it's enough that you don't have to work at a full-time job ever again. So nowadays, based on what the average person spends every month, we're talking about $1 million, $2 million, $3 million for a normal person, and that would be a lump sum that you had invested in the stock market. You could also be financially independent by other means. Maybe you have real estate investments. Maybe you have some other income from somewhere else. But in any case, the independent part means that you're no longer tied to full-time employment. You can do whatever you want with your time. Work is now optional. You have FU money, as they say, and you can do what you want with your life. Term number 8 is down payment. This is most often used whenever we're applying for a loan somewhere, and for most people, that's buying a house or a car. So when it's something that's so big, you don't have the cash for it, you've got to get a loan, and oftentimes somebody who's going to give you the money for the loan requires that you put some money down. You put some money up front to say, I can't afford all of this, but I can give you a chunk of it right away. And typically, the more money you put down, the more favorable your terms are, just in very general terms. Because if you're coming to me and saying, hey, I want to borrow $10,000 from you, and maybe I'll pay it back over the next 10 years, but I'm not sure. If somebody else said, hey, I want to borrow $10,000 from you, and here's $500 up front, well, that's a little bit more appealing to me. Maybe that person gets less interest. I'm not a bookie. Why am I saying this example? This is goofy, but maybe they got less interest. Maybe they've got some other favorable term. Typically, banks treat you nicer if you have a bigger down payment. Number 9 and 10 are deceptive ones: tax deduction and tax write-off. The funny thing is that people use these terms and there's really no difference between them. A tax deduction is the same thing as a tax write-off. And that's where you have a qualified expense that reduces the amount of income that you're being taxed on. So a tax deduction is more, in my eyes, like an income deduction, or a tax write-off is like saying this portion of your income should not be taxed. The difference between those terms and the one that I think people sometimes try and use is a tax credit. A credit is where there's a subtraction from the amount of your tax liability. So let's say at the end of the tax year, the government says, hey, you owe $2,000. Well, if you had a tax credit for $500, that reduces that tax liability to $1,500. So right off the bat, boom, you owe less in taxes. Term number 12 is mortgage, and this is a specific loan that is intended for a house, or at least that's the way that 99% of us use the term all the time. If you hear somebody talking about a mortgage, that means they're talking about applying to get a loan to buy a house. The most often used term for a mortgage, which there's another term for you here, is a 30-year term. A term in terms of a loan, wow, I'm saying term so many times, is just the duration of the loan. Whenever it comes to lending, you can pick different timelines for how fast you have to pay the money back. And so most people pick a 30-year term, a 30-year duration for their mortgage, because that allows them to have a small payment. The longer you stretch it out, the cheaper it is for you month to month. The downside to that is that you're going to end up paying more in interest in the end. So that sucks. Number 13 is related to mortgage, or at least oftentimes it is, and that's called amortization. Whenever we're talking about something like a mortgage or maybe a car loan, amortization focuses on spreading out the loan payments over a set period of time. And so it's interesting to look at something like an amortization schedule whenever you have a home loan or a car loan, because it tells you the breakout between how much you're paying in interest versus how much you're actually paying off on the loan itself. This could apply to student loans too. If you understand amortization, you'll understand why debt is not beneficial to our net worth in the long run. Term number 14, I hinted at before, and that's a 401k match. So one of the great things about a 401k is if your employer sets up an incentive for you to save, it's called a 401k match. And you can ask your HR person typically to explain this to you too. If I don't do a good enough job, by all means, ask them. The way that it typically works, though, is somewhere between 1 and 3% of your income gets matched whenever you contribute it to the 401k. There's that contribute word again. So you tell them, hey, I want to know how much is our match? And they say, it's 3% of whatever you contribute. And you say, great, I want to put in 3%. So you put in 3% of your paycheck every 2 weeks, maybe every month, but for me, it was always every 2 weeks. Then the company sends in that same amount, which is equal to 3% of your income, into that same account for you. So day one, boom, 100% gain. Then the money starts growing over time too. Totally amazing. There's one caveat to this, which we'll get to in a little while, and that's called vesting. So keep your eye out for that. If you're interested in 401k stuff, just wait a little bit here. In 10 or 20 words, we're going to get to vesting. It's going to put a little rain on that parade. Financial term number 15 is asset. Think about an asset like a resource that has economic value, a car, a house, an investment account, a bank account, something that has value itself. Whenever we're trying to grow our net worth and get richer and get financially independent, we've got to pay attention to the assets in our life, because those are the things that are going to get us there. Could even be a business that you own. That's a huge asset. The opposite of an asset is term number 16, which is liability. Liabilities are the opposite of that thing. They hold us down. They're debts that we owe. They're loans. They're anything that creates a negative balance on our net worth. Yikes. Those are not great. So if we want to grow our net worth, we've got to grow our assets, reduce our liabilities. Term number 17 is IRA. You hear people talking about money and IRAs and contributions, and you're like, what the heck is this guy talking about? That's some kind of Irish army? No. IRA is individual retirement account. So the difference between something like this, the main difference, and a 401k is that a 401k has to be hosted by your job. An IRA is hosted by nobody. It's all yours, baby. So it's an account that's set up for retirement, which means that the money that goes in there is generally intended to stay in there for decades. You get a tax break for doing that, but the money needs to pretty much stay in the account because it's for retirement. It's not a savings account. It's not a checking account. It's designated for someday in the future. Terms 18 and 19 are the two different kinds of IRAs that are the most common that most of us use and have heard of. 18 is a Roth IRA. A Roth IRA is really cool and it's an amazing account for most people as long as you don't have crazy high incomes, because what it allows you to do is to put in your after-tax dollars, so money that you've already paid your income taxes on, like money that you get in your check every month, like money that you spend on burritos and race cars. That same money goes into this account, it gets invested, and it grows over time for your future. And because it's already been taxed, it never gets taxed again. In the history of all mankind, the growth doesn't get taxed. Whenever you pull it out, whenever it comes time to retire, that doesn't get taxed. It's an amazing, amazing vehicle. Plus, you can withdraw, you can take out your own contributions at any time for whatever you need because you already paid tax on them. It's your money. It's not the government's money. So this is a very flexible, powerful tax-advantaged individual retirement account. A traditional IRA is really similar because it's still an IRA. It's still an individual retirement account. You own it. It's not tied to your job. But the main difference between this one and a Roth is that the tax benefit you get from a traditional IRA applies to you this year. So those terms that we just went over a little while ago, the two tax terms, this is where those babies come in. A traditional IRA gives you a tax deduction. That means that the government sees you spending money into your traditional IRA, and they know this money is not going towards burritos and race cars. This money is going towards this retirement account, so we're not going to tax him or her on the money they put in there. Let's say you put $5,000 in there. They can look at your income then and say, whatever we're taxing this person, we're not going to include that $5,000 in our figure of taxes. From their perspective, that money doesn't exist. It's not even part of your tax equation for this year. So you save whatever money you would have been taxed on that this year. The caveat is that whenever you pull that money out for retirement, way in the future, when you're 63 or whatever, then the money gets taxed. So the government's basically saying, we'll give you a tax break for now. We'll just come back and get it later. So depending on your preference of when you want to save money in taxes, either of these are very powerful options. Term number 20 is net worth. I already dropped it before. Sorry, I didn't explain it. But net worth is where we take all of your assets, your money, your bank accounts, things that are worth real value, not every little single thing in your life, not like pack of gum, 1 penny, PlayStation controller, $15. Like, you don't get to that granular of a level. You typically stick with the bigger things, house, car, dollars, business, that kind of stuff. You add up all of the assets, and then you take all of your debts and things that you owe money on, and you subtract those out. Those are your liabilities. So let's say between all of your assets, you had $100,000 worth of stuff and money, and you had liabilities like student loans and credit card debt and a car loan and all that stuff that was worth minus $80,000. That means your net worth is $20,000. And yes, it's possible to have a negative net worth. Definitely possible. Banks and people will loan you money pretty much endlessly. So you gotta watch out for that. Term number 21 is one of my favorites also. It's called equity. This is basically the value that you have in something over and above what you owe on it. There's lots of different things you could have equity in. For most of us, the most common thing we might have equity in is our own home. So whenever you buy a house for $300,000, you put a little bit of money down on your mortgage. They loan you some money. And then over time, as you pay off that loan, hopefully the house value is staying the same or maybe going up a little bit. That difference between the value of the house and the amount of money you have left on your loan, that margin in there is equity. And the tricky thing about equity most of the time is it doesn't actually help you today. It's a nice number on a screen. It's a nice number on a piece of paper, like I've got $40,000 in equity in my house, or I've got $400,000 in equity in my house. That's cool, but it doesn't mean you're buying a Lambo with it. It just means that if and when you ever sell the house, you can realize that difference. You can have that equity to do something with. Maybe you need it to buy another house. Maybe you sell the house and go live in a tent and you just take all the money and you sleep on it. You stuff your pillow with it. That's really cool and nice. But the same thing applies for anybody who might have like a business interest. Whenever you start working in a brand new business, like a startup, you might get offered a small amount of pay in return for a chunk of equity of the company. Equity means ownership. So the people that worked at Facebook back in the day and only got paid $25,000 per year to work there, that part sucked. But when they got 1% equity in the company as a result of that, then the company ended up being worth a lot of money. They had shares to sell. They got a big payday at the end. That part ownership in the company was worth a lot. Equity is a good thing. Term number 22 is marginal tax brackets. This is a very nerdy thing that most people get kind of misinterpreted. But think about it this way. Your tax brackets work like a bucket filling up with water. At the bottom of the bucket, you have a 0% tax bracket. That's depending on you and your marriage status and how you're doing your taxes and all that jazz. There's an amount of money that the government will let you earn for the year, and you have to pay 0 taxes on it. That's really cool. And if you keep filling up the bucket, if you keep earning more and more above that, then there's a tax bracket that costs you some money. Maybe it's 5% or 7% or whatever, depending on you and your situation. That next bit of money costs you a bit more. Then the next tax bracket above that, if you keep filling up the bucket, if you keep earning more and more income throughout the year, that next level of water costs you even more money. Maybe it's 14% or 16%. And that keeps going up and up and up until you reach the top tax bracket, which is like 35% or 38%, something crazy. And that top echelon of your money, just that chunk of it, gets taxed at that rate. That amount of money gets taken away from you. The misinterpretation people have is they think that if you go over one tax bracket level and reach the next one, that all of the money below that gets taxed at that big number. Oh no, I don't want to raise. It'll bump me to the next tax bracket. You've heard someone say that? Ridiculous. That's not how it works. Each little section, like layers of a cake, are independent of the other layers because they only get taxed at that chunk themselves. Have a whole video about this if you want to watch it later. Principal is an important term to know. It's number 23, and this is the amount of your loan payment that's actually going towards paying off your loan. This is something that people, I think, get confused with their student loans because they see payment and they assume, oh, I'm paying off $300 of my loan every month. No. Your loan payment, whether it's your mortgage, your car payment, your student loans, whatever it is broken into 2 chunks. Principal is the amount that actually goes towards paying off the loan. Term number 24 here today, interest is the rest. Interest is what that lender is getting paid for the risk of having loaned you the money. And so at the start of basically every loan, almost all of your payment is interest. That means the lender, the bank, whoever it is making sure they make their money up front. Maybe you're only paying off $10 per month towards your student loans because $290 of your payment is interest. That's why you could be 15 years into your student loan and only have a part of it paid off. And you go, how have I spent all this money on this loan and I haven't hardly paid anything off? Because it was all interest. The whole front load of every mortgage, every car loan, everything is interest. That way, let's say in 5 or 10 years, if you change jobs, you become suddenly irresponsible. Well, they've already made their money. They don't have to worry about it. They're prioritizing themselves. And that's the power they have as being the lender. Term number 25 is an amazing one. It's a 529 college savings plan. This used to be a plan that was really only good for educational expenses. Whether your kid went to a private school before college or whether they're going to school or whatever, you could use all these funds for those educational expenses. It was all fine and good. There could be some tax savings. It was okay. But recently, there have been massive changes to this account and it's made it incredible. I made a whole video about this. The big takeaway is you can roll money out of the 529 and into a Roth IRA for the student if you've got extra money in there. So whether or not the student goes to school, I think everybody should use a 529 because let's say the kid goes to school, you find a way to not touch the 529 money. You can take $35,000 of it and put it in a Roth IRA for the kid. So by the time they're in their mid-20s, they've got 35 grand put in their Roth IRA already for them. That's an amazing head start. Even if you know your kid's not going to college, I think college savings plan will be worth using. So watch my video, find it if you want to see all the details on the 529 plan. Financial term number 25 is active portfolio management. This is the evil villain of investing, if you ask me. It's not that terrible actually, but it's not the best. I prefer term number 27, which is passive portfolio management over active. Active, whenever we're looking at our investments, whenever you're looking at a fund or an advisor or anything like that, active means you're paying a human being to touch stuff for you. It sounds kind of dirty. It's not that. You're paying a human being to move around your investments, to manage things for you. Because there's a human involved, they get paid a lot more than when there's not a human involved, and that's passive management. Passive means the computer is kind of set up to do it, or you're tracking an index of the stock market. There's no people involved whatsoever. It's very, very cheap to not have to pay humans. Cheap means good for us when it comes to investing because that lowers our fees. Some people like an active portfolio management strategy because they think, hey, this guy's really smart. He will make me more money if I go with him. In history, thus far, across the whole span of the world and everyone who's ever invested, like 95% of portfolio managers don't do that. So I don't think it's worth it personally. Term number 28 is asset allocation. What's a fancy term? If the terms had outfits, this would have like tuxedo on. It would be like rolling out of a limo. Hello, my name is asset allocation. Sounds fancy. It's not that fancy. All it means is the proportion of the pie that you've chosen to put together. Imagine if you had a pie and you had to pick multiple flavors in it, or you could pick one, I guess. But your asset allocation is saying, how much of each flavor do you want? I want half apple pie and a quarter cherry and a quarter pumpkin. That's like your investing account. I want half VTI, a quarter VXUS, and a quarter BND. There you go. Fancy asset allocation. It's like the percentage breakdown of the different stuff you've shoved into that one account. Not so fancy, actually. Just sounds fancy. Term number 29 is required minimum distribution. If this was a movie character, this would be like the Trenchable. You must go in the chokey. You must use a required minimum distribution. Some kind of drill sergeant. These are often abbreviated as RMD. And what this means is it's the amount of money that you have to withdraw from your retirement account at a certain age. So it's not all retirement accounts, it's just some of them. Typically it's traditional IRAs, traditional 401ks. Right now, I think the age is 73. But what that means is if you have money in that account, and let's say you didn't plan on retiring or withdrawing that money, well, too bad, so sad, you have to take money out. And the reason for this is the government's basically saying, look, we have deferred your taxes for long enough. Now we have to start getting our money back that we knew we were going to get whenever you put this money in this account. It's time for us to start getting some tax money. That's what we got to do. Some people like this, some people don't like this. Just one of those things you factor into your retirement plans, you calculate it out. I don't think it's a huge deal, but it can be kind of annoying. Term number 30 is capital gains. It's not a book written by Joanna's husband, even though I did read that book. It was okay. Capital gains refers to profits that you gain whenever you sell capital asset. And so for us, whenever we're investors, like a normal person like me and you, we're not Jeff Bezos or somebody like doing big business deals. Our typical interaction with capital gains is whenever you have invested in something for a while, you have a profit, then you sell that asset, whatever that is, like an investment. Let's say you sell part of your brokerage account and you profit $1,000. That $1,000 is a capital gain. Typically, it's wise to be aware of the different kinds of capital gains taxes there are, because some of them are incredible, like long-term capital gains. Some of them, not so much. Like short-term capital gains, not that incredible. Think about capital gains as profits, basically. Very similar term. Not exactly the same thing. It's way more complicated than that, but in layman's terms, that's basically what it means. Term number 31 is certificate of deposit, CD, not compact disc that your dad plays in his old truck. A CD, a certificate of deposit, is basically where you give your money to a bank or some other financial institution for a set period of time. Then in return, they lock in an interest rate that they give you back for that. So they say, hey, you want a 6-month CD? Sounds great. You'll get a 5% APY and we'll let you know when your money's back. So you sit there and you twiddle your thumbs for 6 months and then they go, bing, email, hey buddy, here's your interest and here's your money back. And you go, thanks, guys. It's a very safe, secure way to invest. Historically, it's not been very good returns. Right now, CD rates are actually pretty darn awesome. So it's a viable option for you if you have some cash that you want to stash and you don't want to invest it. Term number 32 is dividends. Dividends are this amazing thing that are very fun, that are part of your investment profits whenever you invest in the stock market. Typically, something that you choose to invest in will have growth associated with it. So the value of it will go up, which is good for us. That creates capital gains for us whenever we sell, but that's fine. Then the other part of the growth of the profit that we get is a dividend. So some companies, whenever they're doing business, they say, hey guys, look, we have extra money at the end of this quarter of the year. Should we keep all the money and reinvest it into the company to make the company better, more profitable? Should we spend it on a pizza party for the people here working? Or should we give some of it back in the form of a cash dividend to our investors? And so if you are one of these people who owns a little share of that company, even if it's just a piece of a share, you are entitled to a dividend. So what that means is whenever you look in your investing account, it'll pop up and say, hey, look, you got 24 cents for having a share of X, Y, and Z company. And you go, yay, 24 cents. Awesome. You can take it out and spend it, or you can reinvest it in what's called a DRIP program, a dividend reinvestment program, and it'll buy another little chunk of that company. Then the next time a dividend comes around, which hopefully it will, then you get a bigger dividend. And that could be kind of a dividend snowball that accrues over time. You get more and more cash payments. Some people like retire on dividends. Other people just set them to reinvest, which is the best way to grow over time. When you're in a growth phase, DRIP is better than withdrawing. But hey, you do you. Buy your burrito or your race car. Term number 33 is an index fund. An index fund is a group of different investable assets, like let's say stocks in the stock market, that track an index. An index is just a group of investments. So way back in the day, Jack Bogle, who was the founder of Vanguard, invested the index fund because he realized, hey, people are paying a lot of money to work with mutual fund investors when really they're not even beating the index. Like the stock market as a whole, let's say, it could be an index. It's a group. It's like a team of investments, if you will. So he put a fund together that was just the index. It was just the standard. It was like the playing field that everyone was kind of starting from and trying to beat. He just said, let's just do that. And that became tremendously popular. It's a great way to invest, or at least experts say it is. I'm not an expert. Don't do what I say. I'm just a weird guy on the internet. But both index funds and ETFs, which is our next term number 34, are very viable ways for you to be diverse in your investments and not invest in just one or two things. An ETF, for all intents and purposes, is basically the same as an index fund. Let's be honest. To the layperson, to the average dude on the street, index fund and ETF are synonymous. Yes, there's differences in when you can trade them and different rules here and there. I don't think it's a big deal to know the differences. Functionally for us, they're like the same thing. I know that's kind of a cop-out answer, and there's going to be people who are like, that's not what it means. Realistically, that is what it means. It's the same thing for us. If you really want to go crazy with the definitions and spend like 15 minutes knowing the exact difference between an index fund, an ETF, and a mutual fund, then I can link a video in the description for you, or you can just look it up on my channel and say index fund versus ETF versus mutual fund, Brendan Evan, boom, YouTube will give you the video and you can know the difference. Term number 35 is a nasty one. It's part of what it means to invest, but I don't like it. It's called expense ratio. Ugh, that's like the load we pay on our investments. That's what it costs to invest in a certain thing. So these index funds and these ETFs that I just talked about, very nice, jolly little baskets of different investments that you can carry around and have fun with. The cost to carry around that lovely little money basket of different investments is an expense ratio. Kind of a goofy term, but what it means is this is a percentage that they charge you every year to invest in that thing. These companies that create these investments out of nowhere have to get paid for something, right? I mean, they're not just operating like for funsies. They're a business too. So for me, in my book, I want to find an expense ratio that's 0.5 or below. So what that means is it's 0.5% or below. Anything below that, I'm generally okay with. I prefer it to be like 0.1. That's like really low. But you can find index funds and ETFs and mutual funds that have a 1.5% expense ratio. That's very high. That's triple what I'm paying. So you do you. Pick whatever expense ratios you like, but think of it this way. You're just paying a fee to have access to the thing. If you have a higher fee, you're immediately making less money. This is taking away from your returns, just so you know. Term number 36 is HSA, a health savings account. This is kind of associated with your insurance. Oftentimes you can pick from this or something else at work if you've got that kind of access. Think of it this way. When you have an HSA, you have kind of a investable checking account with a lump of money in it that you're contributing into it each month. You can actually opt into contributing into it. With my wife, she's got an HSA. We can choose not to send any money in there, which I think would be very silly because there's triple tax savings on it. But the intent is that you have a higher deductible with this plan, which means you have to plan on paying for more health stuff yourself. But the trade-off for that is they give you this really amazing tax-advantaged account to save into to pay for that stuff. So you get like a little cute debit card that you can pay for health things with. You don't have to. You can just pay for stuff yourself. And some people use this as a massive retirement investing strategy. And I'm gonna make a video all about these in the future. But an HSA is an incredible thing because you basically get like half again more tax savings on this than you do using an IRA. Even though this is really meant for like health expenses, you can actually use it for an investing account to save for retirement later on. Even if you don't do that, which this is more of our plan, hey, let's save as much money as we can in this thing. Whether we use it for retirement or not, who knows? But we have this big lump of money that we can use for medical expenses if we need it. So it's sort of like a medical expense account / investing account, and it's part of the actual kind of health plan you choose. It's typically part of a high deductible health plan. I think they call it an HDHP, something like that. I'm not an insurance professional, so don't hold me to that, but it's a pretty amazing account if you're willing to have a high deductible. High deductible means the amount of money that you have to pay to reach the point at which insurance kicks in and they start paying for something, anything. So maybe on a traditional plan, your deductible is like $1,000. So you break your leg in half. Okay, well, I pay the first $1,000, then they pay everything after that, or they pay 80% of stuff after that kind of thing. With an HSA, you might have a $6,000 deductible. So you have to pay just out of pocket, out of your own bank account, the first $6,000 of expenses to fix your broken leg that's in half. Then the benefits start to kick in kind of after that. So you've got to make sure that kind of makes sense for your life. Term number 37 is inflation. Yuck. Nobody likes inflation. This is when the price of basically everything in life, but oftentimes for us, it's our goods and services and electricity and food and all that kind of stuff goes up over time. The price is going up. In recent years, inflation has been crazy high. Like 6%, like ridiculously high. Typically, the goal for inflation is more like 2 or 3% per year. But think of it this way. If you're not getting a raise of 2, 3, 5, 6% per year, then the actual amount of stuff you can buy for your money is going down. You have to keep up with inflation to keep up with your same lifestyle. It's a tricky one. Term number 38 is a vesting schedule. This is that other shoe that I was going to drop with a 401k match over here. The vesting schedule is a very annoying thing that's part of a 401k match. And what this means is you have to wait to get that match money. So in our example here earlier, let's say you put in 3% of your pay, your employer puts in 3% as a match. Thanks, boss. I love you. I love you too. You shouldn't say that to your boss. That's like an HR problem. Don't say that. So now you've got 6% in this account, 6% of your income, even though you only contributed 3%. What a win. Au contraire, sucks to suck. Turns out you have a vesting schedule. I've heard of vesting schedules up to 6 years long. Ridiculous. Sometimes it means that match will be stretched out over that whole time period and you get a little piece of it each year until finally after you've served 6 years at the company, you get the full match. But then all the other money that you've been contributing along the way still is subject to the vesting schedule. And so it's kind of like this golden handcuff situation, this incentive for you to stick around whenever there's a vesting schedule, because it means that you're not going to get all of your match money if you leave. And so it's really annoying. I would recommend if you somehow had like identical job offers and you really wanted to use a 401k from each, and one of them had a ridiculously long vesting schedule and the other one didn't, that you'd probably be happier with the one without a vesting schedule, because what that means is you get the match right away. It's your money. It's in your account. No one's taking it away. It's yours. My wife's job, no vesting schedule. My old job, 5-year vesting schedule. Yuck. Terrible. Term number 39 is refinance. The best way you could probably encounter this term in the wild is if someone refinanced their house for a better interest rate. So my wife and I did a few years ago. It was really great for us, but refinance doesn't always mean good things. Maybe you come into a difficult stage in life and you're trying to refinance something that you have some equity in, that you have some value in, some ownership in, so that you can get some cash out of it to pay for an expense. Refinance is a loan redo. Think of it like a redo. So for my wife and I, we said, look, we're paying this much interest on our home loan, and now home loan rates are way down here. So if we redo our loan, we just fill out all the paperwork again, we go with a different company, but they loan us the same amount of money, then we save that difference in the interest. And so we were able to cut off like 8 months off the term of our mortgage, plus we saved a bunch of money in interest in the meantime, and it was totally worth it for us. So think of a refinance as a loan redo. Term number 40 is a target date fund, and this is a really cool way to invest if you're interested in that kind of a thing. Think of it like this way. A target date is implying you have a target retirement date. It's not like a target date like you take your girl to the Target store and you walk around and you like go to the $1 section and then you buy her like a gift card to somewhere and like some lotion and you're like, hey, we had a target date. No, think of this as a date in the future, like a 2045 date in the future. That's the year, or a 2055. So typically you find out, hey, my average retirement age based on kind of the norm is like 62. So you take your age, you go to that time in the future. And so for me, it'd be like 2050 or so would be the target date fund I would probably choose, 2050, 2055, something like that. And the cool thing about these funds are that they adjust themselves over time without having an active manager, without having a human touch your stuff and having to pay them. They just adjust to be kind of more and more what people typically want to invest in automatically. So whenever you're young, let's say you're 21 and you're in a target date 2060 or 2065 plan. Okay, so you put your money into this one investment, you're shoveling it in there, way to go. Right now, it's going to be aggressive. It's going to go after growth for you. This is a good thing. But by the time you're 50 years old, it's not going to be as oriented towards growth. It's going to say, hey man, you probably just saved for the last 30 years. You got a lot of money in here. You probably don't want to risk that money. Growth would be nice, good, but not losing the money would be best. So it actually ratchets down your risk over time to make it less and less risky and more about capital preservation, money preservation, so that by the time you go to retire, you're like, yay, I have all my money. I didn't risk it and lose it all, but when I was younger, I grew it. Good thing. So it's a cool thing if you're kind of a hands-off investor. You don't have to pick that kind of stuff over time. You don't have to pick a specific investment here and there. You find a target date fund that correlates to the year that you're going to retire. Boom, done. And because I believe in giving you extra and more than you asked for, I have an extra term for you. Term number 41 is a taxable brokerage account. Taxable brokerage account is the kind of baseline, most basic, most common kind of investing account. No special tax advantages, but also no limitations. No special intended purpose like an HSA account or a college savings plan 529. It doesn't have any defined reason to exist besides to grow for you and make you money. You can put money in, take money out as fast as you want. But the beautiful thing about even a taxable brokerage account, which gets looked down upon in the world of investment accounts. This is the Rudolph of investing accounts, and people don't even love it that much because it doesn't have tax advantages. The amazing thing is, it still has tax advantages. If you never use a retirement account for your whole life, and you only invested in a taxable brokerage account, and you retired with just money in the taxable brokerage account, you would still get taxed less on your income than a normal person with a normal job, because you still get access to the brilliance of long-term capital gains tax rates instead of short-term capital gains tax rates, which are the same as ordinary income tax rates. Ordinary income tax rates are what you get paid from your paycheck at work, and those are the worst. That's the most you'll ever get taxed right there. So it's amazing the money that you can save by investing in just a taxable brokerage account, taking that income, using that to retire on. It's practically miraculous. I also made a video all about that said, I think it was something like, do you need a retirement account, or is a 401k really the best retirement account? Something like that. I end up getting into the weeds about how those tax brackets work out and how much money you can actually pull out. It's like 6 figures per year, pretty much, that you can pull out if you're married filing jointly without taxes. Ridiculous. It's amazing. If I missed some terms or you want more explanation, then comment and I'll either link you a video or I'll say, hey, thanks for the suggestion. We'll put this in the next terminology video. And until next time, I'll see you guys later. Bye.